Hey guys, welcome back. You're still tuned into Power Breakfast on CNBC-TV18, and let's bring you some updates on the macro front. The government released the FY23 advanced GDP estimate numbers on Friday, and it expects GDP growth to slow down to 7%. This is for FY23, which is slightly higher than the CNBC-TV18 poll of 6.9%. The government is also projecting a nominal GDP growth of 15.4% and a gross value addition growth of 6.7%. Now remember, these numbers are significant because they form the base for the government's budget projections for the next financial year. So this is something important that we had to bring you up to speed on. That's on the macro front, but let's talk about the earnings season, which is back today with IT bellwether TCS due to report third quarter earnings later today. How are the numbers stacking up? Rima is here to bring us all of the expectations. Rima, good morning. How's it looking?
Well, this is going to be a precursor to what the IT season is going to look like in Q3. So it's not just about TCS, but the commentary will set the tone for the other big boys as well. So the question is the slowdown worsening from here on? Or has the slowdown already been priced in? Because take a look at something like TCS. TCS is currently trading at 25.5 times forward multiple. But the peak multiples were 31, 32 times, which means we've seen a very sharp derating. That said, TCS is still at a premium to historical levels. So it's somewhere in the middle, somewhere on the fence, and Q3 will provide some color. What's the street expecting? A dollar revenue growth of 1.65% on a quarter-on-quarter basis. Constant currency revenue growth is seen around 1.5%. But this, remember, is slower than the average, or lower than the average of nearly 3.5–4% that we've seen over the past 8 quarters. So there is a material slowdown which we're going to see in the growth numbers this quarter, partly on the back of the fact that Q3 is seasonally weak, but this time we are seeing higher furloughs due to macroeconomic uncertainty. Margins are likely to expand for the second consecutive quarter. This will be led by the INR depreciation versus the dollar, and 2, easing supply side. Attrition has been falling down, so there is lower backfill cost and operational efficiency. So margins, according to our poll, should be nudging up to 24.8% and profits up 6.5–7%. But the question is, does the company hold on to its Q4 exit margin guidance of 25%? Will the company continue to see deal wins in the ratio of $7 to $9 billion that they had guided in the previous quarter? What about furlough? The focus on furloughs is going to be very high. TCS also has higher than peer exposure to Europe and UK. Is that slowing down? The commentary. And finally, commentary about the budget. Calendar year 2023 budget and the kind of spending we are likely to see, and has attrition further declined from the current levels? That's going to be key as well. Back to you.
All right, Rima, thanks a lot for taking us through all of those expectations from TCS. We will wait by till the evening till we get those numbers. And this entire week could, of course, be a lot about the IT names. But we are going to get into a short break on that note. When we come back, we're tracking all of the cues from